Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 194. Well, last episode was all about the July meltdown, and today we're going to talk about some of the things that caused that to happen. We now know some things we didn't know when that episode was recorded, specifically Situational Awareness, the hedge fund that got themselves in a little bit of trouble with leverage. So we're going to discuss that, discuss kind of where the market is now, talk about where we go in August, and also just clearly point out how damaging leverage and trading on margin can be. So as always, get your mind right and let's get to work. Well, welcome back to the podcast, everybody. Thanks for joining me once again. Hopefully this will be a pretty good episode. I actually had to get some notes for this one to try to keep up with all the moving parts. But we look at the markets. Man, we were really doing pretty poorly at the end of July. And now you look early part of August, and we've had this massive ramp up. Kind of the seems like the market kind of got its feet back under itself a little bit. And we're going to talk about, why that happened. Definitely some things going on that when we recorded, like I said in the intro, when we recorded the last episode, there were some things going on that the investing public wasn't really aware of yet. And so we'll discuss that. We'll also discuss some Palantir earnings. And I wanted to start today, though, where you saw this past week, the jobs number wasn't good and the market rallied on that. And so it seems interesting that the U.S. didn't add as many jobs as expected and the market goes up. So why does that happen? Well, that happens because if the U.S. isn't adding as many jobs as expected, then that means maybe the economy isn't doing as well as everybody thinks it's doing, which means the Fed won't have to raise interest rates. So as we've talked here numerous times, there's a worry. The market will go from worried to not worried on whether they think that the Fed is going to have to raise interest rates or lower interest rates. And so, again, interest rates, they're part of the decision when it comes to investing, but they shouldn't be the only thing that you base your investment decisions on, because so much can change between, I think the Fed's going to raise rates. I think the Fed's not going to raise rates. We've seen it from the beginning of the year. Everybody expected there to be rate cuts this year. There haven't been any. And we've gone from rate cuts to maybe needing to raise rates. And so not a great way to live your life. I mean, they can be part of the decision, but not the complete decision. So we'll see what happens in a couple weeks. The Federal Reserve, they go to Jackson Hole, Wyoming. We've talked about in the years past. There's not actually a Fed meeting this month, but they do go to Jackson Hole, Wyoming. They discuss everything going on in the economy. And so, of course, everybody will be looking for clues and maybe trying to figure out what they're going to do at the September meeting, which is the next official meeting. So let's talk about why we had this massive correction in July and then what has kind of transpired since then. So on the last episode, we talked about the South Korea stock market, the KOSPI, and how it's mainly made up of Samsung and SK Hynix. SK Hynix is a memory maker. And we discussed how there has been a lot of leverage in that market. And remember, leverage is all about borrowing money. And so much so that about 1.2 million Korean stockholders, people who had accounts in South Korea, got margin calls. So a margin call is when you borrow money to invest. So you have leverage, you borrow money to invest. The stock starts to not do well, so it starts to go down, and the bank comes to you and says, hey, you got to put more money in. And so that's a margin call where the bank comes to you and says, hey, you got to put more money in. Banks love to loan you money to allow you to be able to trade more than you actually have in your account. So they let you borrow money to trade. But the one thing about that they don't like to lose their money. They're okay with you losing your money, but they don't want to lose their money. So they get what's called a margin. You get what's called a margin call right before you start losing the bank's money. And they go, no, we're not going to lose our money. Remember, we only lose your money. And so they say, if you want, if you want to keep trading, if you want to hold these positions that are currently in your account, if you don't want to be forced to sell something, you have to put more money in the account. And so we're getting all of these, we have these exchange traded funds, so ETFs, but we're getting these single leveraged ETFs, which are exchange traded funds that have leverage. And again, I'm just kind of reiterating what I talked about last week. So we get these ETF that already have leverage in it. And then we get these investors that are using leverage to buy leveraged ETFs. And so even the South Korea market was like, okay, this is getting a little out of hand. They changed the rules on this during the month of July. And so, that kind of starts the tidal wave, right? And that kind of comes all the way around the world, and it comes to the US. And it comes to the US through a hedge fund called Situational Awareness. Situational Awareness is a hedge fund that was created by a 24-year-old. It used to be a former OpenAI researcher. His name is Leopold Aschenbrenner, and he was doing wonderful for this hedge fund. I mean, he's been in the news all year long, great investments, great performance. His performance he's up like 400%. So that is a clue, by the way, when you hear that somebody, especially like a hedge fund, if you hear somebody's up 400% in your mind, you should automatically be thinking, okay, they have to be using leverage, because leverage allows you to be able to maximize, it allows you to be able to really maximize your performance. And the way that you do that is with borrowed money, so that you're getting you're getting a magnification of your performance on the upside. The problem is that you also get a magnification of losses on the downside. So let's wait for that part. So he's 24 years old, used to be a researcher for OpenAI. He wrote a paper called Situational Awareness, where he discussed, all of this stuff with AI and how it's going to come around a lot faster than people expected. And so he really got in front of this wave of kind of all the AI investments. So he probably had around $10 billion worth of investors' capital. He used leverage and he borrowed money against that. And so maybe he borrowed another $10 billion on top of that from JP Morgan Chase, Goldman Sachs, kind of the big boys of banking here. And then those investments started to do well. And so that fund grew to about, I think, 40 to 45 billion. Now, there also are a lot of private investments inside of his fund. So he does have an investment in like Anthropic and some other companies that are private, so that have not gone public yet. And then he had this public portfolio, which is going to be names that you recognize and that you know. So NVIDIA, Broadcom, AMD, Oracle, SK Hynix, SanDisk, Bloom Energy, CoreWeave, some of the companies that we've discussed. So he did own a lot of those public companies. So one of the things to keep in mind here is that when you look at just the rules of investing, hedge funds basically I'm not saying they don't have any rules, but they have a lot different rules than like retail investors, somebody like you or I. There's certain things that are in place. So when you look back at investing history and you look back at like the Great Depression, and one of the things that caused the Great Depression was the fact that so many investors were using margin, and to the point where they were using almost 100% margin. So that means that for every dollar they had invested, they had also borrowed a dollar, which is particularly painful when the market starts to go down and you start to get significant losses. So because of that, the SEC, the Securities and Exchange Commission, they came out with rules in the 1930s that basically limited investors, retail investors, from being able to put too much margin on their account. So if you go to Schwab or you go to Robinhood or you go to E-Trade or any of those places and you want to use margin, I would go against that. I would say don't use margin. But if you want to trade on margin, they're going to limit you to how much margin they're going to allow you to use. And they're probably going to do a little bit too based on your experience. So they're going to they're not going to prevent you from hurting yourself, but they're going to try to limit it a little bit, especially if it was something that was going to go around the market. So that to be said is that hedge funds, they don't have those same rules. So hedge funds work with what's called accredited investors. So these are people who have either taken some security exams, or people who make a certain amount of money every single year, or they have a net worth of a certain size, so that, they're taking a small portion of their net worth, they're giving it to this hedge fund, and they realize that they're going to be much more aggressive with those funds than somebody else, maybe say an RIA or a registered investment advisor. And so, but they're basically saying, okay, if you have your securities licenses, you obviously know the risk. If you have a net worth of this much, or if you make this much per year, you can handle this kind of exposure. So because hedge funds work with accredited investors, they don't have to work off the same rules as everybody else, and they can have higher levels of leverage than everybody else, meaning they can borrow a lot of money to make these trades. And so you see this happen. If you look over time, you see this happen where you get these hedge funds where they do well, and then they kind of implode because something goes wrong, and it usually comes down to leverage. Okay, so fast forward, here we are today. Leopold is using a lot of leverage in this fund. And interesting enough, like by the end of June, he was up 400%, I think, which is pretty tremendous. I mean, to be up 400% is pretty absolutely amazing. I think we could all agree on that. And he sends his investors a letter basically talking about how well they've done. And then all of a sudden, because of what's happening in South Korea, and because a lot of these holdings have basically had a correction during the month of July, he starts getting all this pressure, and these positions start losing money, and they start losing money rapidly because he has borrowed so much money. And so all of a sudden, these losses start to trigger margin calls, because just like two of his positions, one was Bloom Energy, one was SanDisk, they were down 40%. In the month of July, and to be down 40% in 1 month is quite crazy. And so, he sends the letter, says we're up 430%, and then he's like, hey, this would be a good time to maybe put more money in. And then a week later, he starts getting these massive margin calls, and the margin calls again are like, you have to put money in, or we're going to have to start liquidating your positions. Now, the problem with that is you're normally going to have to liquidate positions that you don't want to liquidate because they're stocks that are down for whatever reason. In this case, South Korea changed the rules on a lot of the leverage. So that means there's a lot of people selling, there's a lot of individuals and traders selling in the South Korea market. I think those leveraged ETFs went from like 50 billion in assets down to like 15 billion. So there's a lot of selling going on, a lot of selling pressure in these names. And then obviously he's so concentrated in these names and he's got leverage, it just magnifies the downside of this. So then he has to start looking for somebody to basically bail him out so that he didn't have to sell all these positions. And then you have some other hedge funds that basically are looking for this position. The one that ended up winning was Ken Griffin with Citadel. And he gets to come in here and buy all these securities at a hefty discount. But what that does is Ken Griffin goes in there, Citadel, he buys these positions, takes them off his hands, gives them at a discount. But then now the market knows what was causing all of this volatility. They realized that somebody, was getting a margin call. Hedge funds are not nice. There's probably some other hedge funds that found out. They start shorting those names that they know that another hedge fund has, putting more and more pressure on them. Ken Griffin comes in, he buys those, and that basically puts a floor on the market. And then those securities start to come up after all that deleveraging has happened. And so, that is a lot, but that's a lot of what happened at the end of July. And, it's just kind of another story of how quickly liquidity can get retail investors in trouble. or margin and leverage can get retail investors in trouble, hedge funds in trouble. His fund is still around. I mean, he still has a lot of the private investments. He actually looked at selling the Anthropic position to try to, create liquidity and to keep the fund running. But obviously, I think he was down about 67 to 70% in July alone. So that's basically you start July with $100 and you end with $33. Not great, which means he's going to have to go up another 200% from that level to make that money back, which is not going to be easy. And actually, he told his investors that he was going to eliminate leverage altogether, which is normally what happens when you lose a lot of money rapidly and you almost lose your entire fund. And so, a cautionary tale here. But you can be, the thing about that is you can be right and you can have the right positions and you can have one bad month, which is a 10% correction in the market, a 10% correction in the NASDAQ, which is going to happen about every 16 months on average. You can have one bad month and it almost completely wipes you out. And that's why leverage can be so damaging, because you can be right and it'd be the wrong time. And so, worst case scenario, if you don't use leverage, if you don't use margin in your account, and that's where you see it. Like when you go open an account at Schwab or E-Trade or any of those places, when you go open an account, it'll ask you if you want margin. You can say no. I would recommend that you say no, because when you add margin, they don't do a good job of letting you know that margin is basically borrowing money. And the reason they want you to borrow money is because they're charging you for that. There's an interest rate attached to that. They're probably charging you almost 8% for any dollar that you borrow. And so that magnifies the losses as well, is because not only are you going to potentially lose some of the investments that you have, but then you're going to owe them interest for borrowing that money from them. And so you got to be very careful. And a lot of times, investors get themselves in trouble because they just don't realize the ins and outs of that, and they don't realize how quickly some of those margin calls can happen, and they don't realize how much leverage they're actually using. I'm sure that happened with many of the investors that were using leverage and then investing in leveraged ETFs, and so they're magnifying that out. But you just have to be careful. So to me, the stock market is stressful enough that I don't really want to bring in margin. I want, at the end of the day, worst case scenario for me is I end up having to own something longer than I want. You never want a bank or somebody else to be able to come in and say, oh man, you got to sell this. We're selling this today at noon if you don't deposit more money in your account. And so you just have to be very, very careful with that. And so, just another great cautionary tale of this, and something that was, something that happened in South Korea market that ends up coming all the way around the world, which ends up knocking this domino, which probably knocked a lot of other dominoes down of just individual retail investors that own these companies and don't really understand why they're down so much. And so again, that's why like some of these AI names, it's such a crowded trade. Like everybody is in these names around the world. And so you just have to be cautious with that. I mean, some of these companies are really, they're fantastic companies. The earnings are fantastic. They look really good, but it's also, there's a lot of individual investors and just investors in general that are in these trades. So let's talk about a company that hasn't had a good year. Palantir. One we've talked on, on the podcast for many a year here. But Palantir hasn't done well all year. And then this week, they report earnings on Monday. They go up 30% on the earnings, and they go from basically 129 to 160. Close you get some profit taking happen, and then they just keep going up. Now they're at 170, 172, I believe. And, you look at Palantir's numbers, and the big, standout to me was the growth in corporate America. The growth of corporate companies signing up with them is up 149%. And kind of the negative has been that, Palantir's had a lot of government contracts, and are people going to use them? That kind of thing. So these numbers, they guided up, looks pretty good. Obviously, valuation is expensive, which is always going to be the negative on them. A lot of really good companies look expensive at some point. But Palantir, it's nice to see that one come through. I think when you listen to Alex Karp, I think one of the things that he says that I think is going to be right on is he brings up time and time again that corporations don't want to just plug all their data into these large language models. They don't want to just plug their data into, AI and have all their secrets, their corporate, all their corporate information, that they're going to want somebody to basically be between them and the large language model. And that's Palantir, that's ServiceNow, who also got completely beat up this year as well. They've had a nice little resurgence here over the past week. So it'll be interesting how beginning of the year, nobody wanted any of the software plays. And then now we're starting to get that little, rotation back into them. We'll see how long that lasts, but it's very interesting how quickly it can change. I think that's maybe one of the main lessons of this episode, how quickly June looked good, July horrible. We'll see how August looks. August is typically not a great month, but July was so bad. I think it was the worst July in like 15 years. So we'll see what that happens. But, you look at some of these names again, and because we kind of know what happened, now you're seeing the confidence come back to these names that, there were some big time, managers that were having to sell this. Will it calm it down? I don't know. We'll see, but I think everybody feels a little bit better knowing that there was something going on under the surface that was a little unusual. So, cautionary tale, go do some homework, go look up situational awareness, pull some of the articles. There's some good articles out there about it, but also a great lesson in leverage and how quickly it can turn on you and how quickly it can damage your portfolio. So, as always, I hope this was helpful for you. And we will see you next time. Thanks, everybody. This podcast contains general information that may not be suitable for everyone. The information contained here should not be construed as personalized investment advice. There's no guarantee that the views and opinions expressed in this podcast will come to pass. Investing in the stock market involves gains and losses and may not be suitable for all investors. Information presented here is subject to change without notice and should not be considered as a solicitation to buy or sell any security. Ryder Equities does not offer legal or tax advice. Please consult the appropriate professional regarding your individual circumstances. Past performance is no guarantee of future results.